All right, we are recording, so I'm just going to do a quick introduction. I'm going to introduce Graham, and Graham can introduce his team. So what we're here for today is to talk all things lending. And as everyone's probably aware, so we're in November 2022. Interest rates have hiked higher than we've seen them in a while. Everyone's kind of, well, I was about to say losing their minds. We'll be honest, everyone's losing their minds. And so what we're going to talk to Graham and his team about today is hear from the lender side. What's going on? What can we expect as investors? How can we best be strategic with our investing? How do we work with these higher interest rates? And yeah, so we've got a lot of good stuff coming. I know every time I talk to Graham, I learn a ton, and it helps me strategize with my own investments, because I think the worst thing people can do is stop buying. So we're going to talk a little bit more about that. And I know my goal for everybody is to hopefully get you more comfortable in a comfort spot about how to work with these rates so that you're not losing out on perfectly good investments being fearful of the rates. So Graham Parham, if you have been around turnkey world at all for, I mean, what, at least a decade?
I hate to say at least 25 years.
Yeah, or 25 years. I've only been around for a decade. But Graham is definitely one of the biggest turnkey lenders. He works with turnkey providers, people getting loans on turnkeys. And of course, he does other loans as well. But for the ultimate go-to turnkey guy, Graham is the guy. So Graham, I'll let you introduce yourself and introduce your team, and then I'll let you guys kind of just dive in, and I'll even keep myself muted. But if anybody along the way has any questions, feel free to put them in the chat. You can, if we have a smaller group, just interrupt, and then we'll definitely put a recording out to everybody with all this information. So I'm pretty excited. Graham, super excited you and your team are here.
Thank you, Allie. And is it really possible to actually mute you? I didn't know if that was possible or not, but that's okay.
I can mute myself, and I'm happy to do so. I'm like, whoo, I don't have to talk for one of these.
All right. Well, my name is Graham Parham. I'm with Highlands Mortgage. My production partner, Aaron Stelly, is with us today. And I also have the head of our capital markets here today. His name is Andrew Stringer. Very knowledgeable. He's been in the industry as long as I have. And, we were talking about yesterday, I think it was, or day before, where we were in 08 and where we are now. And it's just a completely different lay of the land. And it's hard for the consumer to understand what we understand and what the secondary market understands. So we're going to try to explain that a little better so some of your listeners can understand when it comes time to getting that investment property, locking in the rate, how that works. So let me just kind of go back in time, and let's take a look at 20 and 21, when all the rates came back, they came to a bottom. A lot of the mortgage-backed securities that were purchased off from Wall Street, the guys that own these notes, they experienced a thing called early payoff. And the reason being is these notes that were originated back in 17, 18, and 19 were at a much higher rate than those COVID rates, because the COVID rates kind of hit the bottom. So what happened is these guys on Wall Street, when they buy these mortgage-backed securities or these notes, they want to keep them on their books for at least 3 to 5 years so they can make some money. Well, the downside is during that time period, they lost money, or all the profit margin that they had that was built in went away because they had an early payoff. And so they recognized this again, because this whole inflation thing is kind of caught us off guard. It went so quick and so fast, and we are eventually going to run into the recession wall. A lot of the economists, Andrew will agree, when is that going to happen? Some people say sooner than later. We don't know. I think between Andrew and I, probably second or third quarter is probably going to happen. And what that means is that we're going up in rates, and eventually we're going to hit the recession wall, and then the rates start to come back down. Wall Street recognizes that. They're saying, okay, so we're issuing these notes now at a higher note rate, but we know for a fact they're going to have an early payoff about a year from now, or they're going to lose money. What that means is when they start issuing these coupons for us to price our loans, this thing called par pricing, which is a kind of an industry term, which means 0 point pricing. Okay. 0 point pricing kind of left the playing field. Andrew, help me out here. What, 5-6 months ago, I guess?
Beginning 2022 or close to.
Yeah. Okay. And what that means is, and Andrew and I, we talked about yesterday that, we've been at 20, 25 years. We've never been able to offer a rate without 0 points. Okay. But today, unfortunately, we can't, because Wall Street's not helping us out. They're not juicing those rates like they normally do. So the profitability is not there.
Hey, Graham, for any brand new people on here, do you want to just briefly explain what points are? Because I know people
Exactly.
hear like if you're going to pay points on a loan, and when you say 0
Exactly.
points, what are you talking about?
All right, let me explain. Points basically is called a discount point. In other words, if I offer you a rate of 7% at 0 points, which I can't, but let's just say I did, and you wanted to buy that rate down. In a normal market, typically 1 point buy down, which is a multiplier against the loan amount. If the loan amount was $100,000, then you bring another additional $1,000 to the table to buy it down. In a normal market, we'll see probably a 1/4 point reduction in rate. I've run these numbers backwards and forwards, and that's just not good on paper because that's a 5.11 year return to buy it down only 1/4. Well, the good thing these days is that even though we're having to pay points to get to the table, the additional buy downs are more than a 1/4 point. They could be 3/8 of a point. They could be a 1/2 a point. So the return on those investments are like 28 to 32 months, which is good. So let's just go kind of take a deep dive on a scenario. If we got a $150,000 house today, and my recommendation is always to put 25% down in this market because the 20% down right now, the additional adders or subtractors from the margin is it's more than double. Okay. So we've been blocking the majority of our loans these days at 25% down. Even at 25% down with a good FICO score, and because there's 4 variables that make up rate. There's FICO score, percent of down payment, the property type, and the loan amount, because there's loan amount adjustments. So let's just say it's coming in at say 7.5 today, but even at 25%, because there's not much margin in those loans that are issued, because right out of the box, there's this much margin for 30-year fixed rate. Then you make adjustments. All right, it goes from owner occ to non-owner occ. And then you go, okay, now we're going with a duplex. It gets even worse. Or we go with a higher minimum down pay to 20%, it gets even smaller. So whatever's left over that's how we price. And we have to price it at par, which means we have to get it to 100.00. But right now, the pricing on these rates are coming in at 98 versus 100. So the 98 from 100 means the buyer has to pay 2 points. It's a reality. And that's the part I really wanted to stress today, because that's very difficult for the consumer to do, because their whole life, when they bought however many properties and did so many loans, they always had 0 point pricing available, but they don't today. And it gets worse on the investment properties because there's more adjustments than even owner occ. But even owner occ, we're still not there. So that's one of the main things I wanted to stress today is how we are with the pricing. But Andrew is going to talk a little bit more about the market. We are actually experiencing a pretty good day today, which we haven't seen in a couple of days, but I'm going to kind of let you take it from here, Andrew, and kind of tell you a little bit about what the market, where we're probably headed and so forth.
Sure. I wanted some visual aid because I can kind of just, shoot from the hip and tell you kind of what I think. But I think if you can follow along with me, it might be a little helpful to see for yourselves. So Allie, I gave you some slides. I think we can start with the one that's called 10-year.
Okay.
As just a jumping point.
Right.
First and foremost, so in the mortgage world, we follow what we call the 10-year index, which is, if you've ever watched the stock market, you always hear about the Dow or the S&P. That's kind of the holistic market or the breadth of the market. When we see the Dow, the S&P going higher or lower, that's pretty much the benchmark of what stocks are doing. The same is true for the 10-year treasury. And so interest rates are most correlated with this 10-year. And so what you're seeing in front of you is our 10-year index. And so as the 10-year index goes higher, so do interest rates. And I've captured this. I zoomed in because I wanted to show you what happened today, which if you look at that sharp green line, it's moving down. Interest rates have improved it's about over 100 basis points, I think, today alone. And the reason that happened was because we got a lower than expected CPI, which is the driver of what is really the Fed's watching, our inflation indicator. CPI came in lower than expected. So we're thinking that maybe inflation has peaked out. So as you look at this 10-year, since 2022, and you can't see it all the way in the chart, but the beginning of 2022, it's just been a huge ascent. And if you follow this trend channel down, it would reach much further. But as of today, this huge drop occurred, and we've broken some support levels where you can see that purple line, which is it's the 50-day moving average. That's kind of where we are going to end up most likely, and we'll probably see this consolidate a little back higher. But today could mark a pivotal momentum change for where interest rates are headed. Now, Graham mentioned the recession element. So obviously recession would be a pro improving interest rate. This is another side of that coin, which is inflation is also the killer of interest rates. So as inflation is increased, so is interest rates as well. Ali, if you want to jump to the next slide, which is the let's look at the inflation slide, the CPI. So what has occurred is you have two indicators on this slide. You have the consumer price index and then the CPI, which excludes food and energy. What's interesting is the consumer price index, which really measures the consumer price of goods and services. So obviously, as you've experienced as consumers yourself, prices and goods and services has shot through the roof. And as inflation is measured, that is going to correlate. So inflation drives prices higher. The consumer price, it all feeds into the same type of environment. And what's interesting is the consumer price index actually leads out ahead of the CPI. And the CPI is what the Fed is watching the most. So there's a lag to it. But so you can see as of June, consumer prices peaked out. And then last month, CPI actually spiked, which is why we saw another leg higher in interest rates. But today, CPI looks to be now topping out. And as the lag occurs, what the market is pricing in now is the belief that inflation has peaked. And so if you go to the last slide, I'll finish with this to kind of give you an idea what's really been going on. So this is a measurement of the price movement that's from intraday. So it's in a single day, top to bottom. This is the price movement. And on this chart, it measures in 30 seconds. But every time I've drawn a yellow line, and just to give you background, there's a bunch of different tranches you see that are kind of mirror images. These are really the coupons that our interest rates go into, the lowest being in the top, highest being on the bottom, but they all pretty much tell the same story. But every time I've drawn a horizontal yellow line, it's equated to about 100 basis points. It's 32 seconds. Everything in this market is based on 32 seconds, but just to keep it simple, it's been about 100 basis points in price movement. So what that says, this is a 14-day average. And in the past 14 days, the average movement in a single day of trading in the treasury market, which is our rates, the price can move 100 basis points. And so when you think about a correlation of interest rate, every 50 basis point typically is an eighth in rate. So in a given day, we're seeing as much as 100 basis points or a quarter in rate movement. So you might start the day with a quote of 7%, and then you'd end at the day with 7.25, or vice versa. Never have we seen that type of volatility. If you go look, I pointed out where COVID hit the market. That was the last time we saw this degree of price volatility intraday. And then prior to that, it was back in 2013 with the taper tantrum and Bernanke when they were, coming off QE. But in between those spikes, the lulls, it's only about a quarter in price, or excuse me, it's about 50 basis points in price, which equals about a half interest rate. So
let me kind of interject this
that.
for a minute, Andrew, so the consumer will understand.
Yeah.
When he says 100 basis points, that equates to 1 point. Okay. So as I mentioned before, if you have, the rate 7%, and you want to buy it down 1 point, well, that will buy it down to 6.75. That's what he's trying to explain. We'll see that much variance throughout the day. So that when he says 100 basis points, it's basically 1 point in price, because you have rate on one side and price on the other, and they move hand in hand. So I'm sorry, and I interrupt you, Andrew.
You're fine. No. But anyway, that is just to illustrate how here today, gone tomorrow, this market really is. Today, for example, we see another 100 basis points in a given day, a whole point in price. So once we see a normal, if the Fed starts to look to that pivot that the market is expecting, that's going to be, huge for the market. And what we'll eventually see is a subsiding of the volatility and a normalization occur. But until that normalization occurs, it's likely this volatility is probably going to be here to stay.
So those CPI numbers, they actually are good, favorable numbers, which has a major influence on today in the bond market. Do you think we're still expected to see what's predicted from the Feds next month at 75 basis points? Or do you think less based upon the CPI?
So the Fed's most likely going to deliver 50 basis points as far as a Fed hike in December. That was expected. The fear was if we got a stronger than expected CPI release today, that it would move up to 75 basis points. In reality, it is very early. Now, the market is celebrating. The market has a very bad track record of being over exuberant, kind of clinging to this hope, like just starved for positivity in our markets. So you get this knee-jerk reaction. And we can say this CPI release today is probably the first material data point we could truly build a thesis off of to say, you know what, maybe there is a light at the end of the tunnel. Maybe rates are starting to turn. The 10-year being below 4% in general is a great start. But the reality is we still have a long way to go. And the Fed, which when they met last week, Powell just iterated the mission to not stop hiking prematurely, because if he stops and he resolves to say, okay, we're good, I think the market subsided, and then inflation rears its head again, that's a recipe for disaster. And he's already worried about his credibility with the markets. So although today is a day to celebrate, pricing has improved dramatically. It's still a little premature in the grand scheme of things. So when you think about buying timeline wise, taking advantage of opportunities when you get these gifts, I think it's still prudent to stay the course, base it on cash flow, base it on the prudent, factors that you're basing a deal off of. And, if you get the opportunity to take advantage of days like today, that's great. But if it does go the other direction, or if you buy when rates still go higher, it's oftentimes the refi potential in the future tense is going to be there. I mean, we've come too far too fast. And I think that these levels are already unsustainable. So it's really a matter of time.
What would your assumption be? Like, if the rates are going to come back down, how far down do you think they would practically come?
Well, considering that we got to the place we did by qualitative easing, and a cash surgence of printed money into the system, if the market truly does normalize to where the terminal rate is back to where I would say like the inflation at 2% target, we may not get back there for a while, but when it does subside and the pressures come off, I think it's fair. This is a full-blown opinion, because I do not have a crystal ball, but if I was to say what is a normalized rate environment without artificial money printing, it's probably going to be in the 4s, 5s, not too far. I don't think we get back to historic lows of the 3s for at least I mean, it took a decade. Well, I guess I don't think we ever got this low. I'm not, full disclosure, I'm not super old, but in my 25-year career, this is definitely unprecedented. So in the same regard, the last time we saw rates this high was probably right around the 2007, 2008 level. And we're in a very different market than then. So, I'll split the difference and say, 4.5, 5s, 5.5s. That's probably what I would expect.
When do you think people could start to expect that? Ballpark.
Set your clocks. All right. We're going with
Crystal ball.
January 23rd. That's a great question. I would be curious if we polled this audience to see who would answer, they would answer that. And I think that would be probably just as good of a guess.
I'm going to chime in and say my opinion is going to be second or third quarter. At least that's what I'm hoping for, because a lot of people are nervous. They're sitting on the sidelines. They're saying, I can't cash flow with this rate. Okay. But Allie, you and I both know the seasoned investor right now, they're buying an asset. They're buying a valued asset. And right now, with the rates being high, some of the inventory is starting to move up as well. And we've been experiencing some very low inventories for so long. Now the inventory is out there. Now it's a great time to buy. Even if it's a little bit higher rate, we know we're going to refinance that thing, hopefully within a year or two, and it's going to put everything back. We all know that the rents are going to continue to rise and the rates are going to drop. So it's going to be in line. But the bottom line is the asset is still there. And I'm still buying myself. I've got 43 properties and I've got 10 coming off the ground right now in Florida. So I'm pretty optimistic that when they're done, it's going to be second or third quarter. So I won't be, quite sticker shock like a lot of people are today. Okay.
Yeah, and I want to piggyback off that. And just from my own experience, I'm at the 10-year mark of having started buying rental properties. And what's happened for me this year is people have probably heard me say it before, but I've kind of been doing this look back over 10 years. Like, okay, now I've had these properties for 10 years. What have I not expected that's happened? Yada, yada, yada. And the biggest thing that I did not expect, which sounds kind of dumb, but I underestimated the actual profits on these properties. And what you were talking about is these are assets. They're long-term assets. And I knew about the 5 profit centers, cash flow appreciation, tax benefits, equity build, and hedging against inflation when I bought. But I didn't really take them that seriously. The one I really didn't take seriously was rent increases over time. And so now that I have the 10-year look back, my personal opinion is anybody is crazy not to be buying right now, even if the cash flow is not what we're used to seeing. 7.5% interest rate might be kind of intimidating. I've refinanced a lot of my properties. It's the 7.5, number one, is likely temporary because you can refi when the rate drops and then your cash flow just goes higher. And then over time, that asset that Graham's talking about, the profits, just what I've seen in 10 years is it's not like 5 just individual profit centers. Those 5 start compounding and it becomes an exponential increase. It's like, if you hold a rental property for 1 year, you're not going to get a whole heck of a lot going on. You might get a little cash flow and whatever. But when you hit the 5-year mark, the 10-year mark, everything's crazy. And the rent increases that I've seen on my properties, my taxes and insurance have gone up a little bit, but nothing like the rent increases. So my cash flow margins are crazy now. And my one property that it was my property that I lived in, it was break even at the time. So it was actually negative with a property management fee. And the cash flow started building, the rents increased, and I eventually refinanced it. That sucker's cash flowing $800 a month right now.
Wow,
and that was a break-even property. So, the cash flow is king message. I think Graham, you and I talked about this. Cash flow is king has been a message for 10 years, but I really feel like it's holding a lot of people back. And now with these interest rates, you're like, oh, well, I'm only getting $111 cash flow a month. Like, no. And you've got to start looking at the bigger picture. Like, we're at the time now where I say the men are starting to get separated from the boys. Women and girls, whatever you want to call it, is the investor. You have to be an investor today. You can't be a consumer pretending to be an investor like you could for the last 10 years. And when you have that investor hat on, you really look at those 5 profit centers and you'll very quickly realize that these interest rates are not deal breakers at all. Like, to me, the difference in cash flow from a 7.5 interest rate, the temporary time until you can refinance it, is so negligible of the cash flow that you're missing because of the higher rate. in comparison to the value of the asset and when those other profit centers are going. Now, I do tweak my buying a little bit where I'm not going to buy the, high cash flow D neighborhood property because I need those appreciation and other factors, those other profit centers to be working stronger than maybe I needed them to over the last 10 years. But, I may shift a few things, but the value of the asset, people are still stuck on the 1% rule. No real estate mogul billionaire is a mogul billionaire just because of cash flow. It's just, it's not. Like, cash flow creates a kind of a foundational, I don't want to say safety because that might give the wrong message, but it's part of the equation, but it's not the biggest profit generator. So all of that to say, looking back on my own properties and seeing I've refinanced, everybody can refinance, the lower cash flow right now is temporary. And even if it's not, it's pennies compared to the overall profits of a good rental property.
Well, Allie, I've been investing for 18 years now. And I back 18 years ago, I was dealing with, 7 3/4, 8%. It didn't stop me at all. And back then, could I achieve the 1%? No. Have we as an industry been able to achieve in the last, say, 3 years, a 1%? Well, with all the increasing and appreciation, it's been a kind of a tough challenge and a tough chase, but there's still been great assets. So my point being is I've got properties that I had, 18 years ago. Last year and the year before, I think I probably did 5 exchanges because of the appreciation.
When you say exchange, for people, you're talking about 1031 exchanges.
1031 exchange, yes, ma'am. So, I mean, the secret of 1031, you sell one, you buy 2. And that's when I've been able to grow the inventory. So you may not have that passive income today because the higher rate. You will eventually if you refinance, but think of the long term, because that's what we're all here to do, is to get to that long-term goal and have an adequate passive income, if you will. Andrew, I was going to ask you a question. Now it just slipped my mind. Oh, I know what I was going to say. Can you explain to the audience the difference between interest rate and the Fed rate? Because I think that's where a lot of people get confused.
So the Fed's whole reason for existence is obviously controlling, we'll call it the economic cash flow, if you will. And they do that by what's called the Fed funds rate. And it's basically the cost of what it takes to borrow. And these are invest in institutions, financial institutions, specifically banks. It addresses the cost of borrowing between those institutions. So when you tighten or increase the rate of borrowing, the borrowing cost, it essentially trickles down to the financial services industry and creates the tightened environment we're experiencing. It is very different than the interest rate for consumer as it pertains to the mortgage rates, because interest rates are driven from the treasury securities or the treasury bonds. And the term you hear is mortgage-backed securities. Everything that the market, such as Fannie Mae and your different GSE institutions, they create liquidity in our market, but those loans are traded in the securities treasury market. Now, the reason the Fed funds rate affects the treasury market is, at the end of the day, it is all driven by liquidity. So when you tighten liquidity, you impact financial markets. So it does have a correlation. But the interest rates, the Fed may raise rates as they have, but take a day like today, market's improving. And that's because the expectation is the Fed's going to be less restrictive down the road. The market always prices 6 to 9 months in advance. So just like the Fed hikes haven't truly taken hold of our economy, just because of the pace they've raised the rates so quickly, the market's already accounted for what they believe the effects will be, because they're already anticipating the effects, again, pricing it ahead of time. So that's why a day like today, when CPI comes in below expected, all of a sudden the markets drop out, the bottom drops out, and rates start improving, because now the market's expecting down the road the Fed's going to be less restrictive. They're not going to hike as much or potentially stop. And the treasury market responds favorably. Does that help?
I get a lot of customers, because they see the Fed's raised the rate 75 basis points. That means, oh, okay, so my rate went from 7 to 7.75. Well, that's not how it works. Right now, the Fed rate is sitting on what, 4%? Is that what it's at?
It based on, yeah, it's right around 4, probably
Okay.
gonna end up 4.5, 4.6.
And as Andrew says, it filters down into the consumers because, you know, the mortgage rates, credit cards and so forth. The cost of money to the lender is 4%, but they have to make some money. Same with the credit cards. I mean, how many 0-point credit cards are you seeing these days? Not many, right? Those are always good to take advantage of. But that's really the difference when you say, okay, the Fed's, they're raising the rate today, or they're going to raise the rate tomorrow, 75 basis. Well, we already see it coming. Well, a lot of times, as Andrew says, we've even seen a decline. What was that, 2 months ago in August? When we saw that rate hike, it actually went down about 0.5 point or maybe 200 basis points. Very unpredictable. And that's why Andrew has his job of making sure we stay in line and kind of deliver the message better to the consumer. Where are we with the rates? What's expected? The inflation numbers, Andrew, I didn't see that today. Do you have any idea where we're sitting on that? I think last time we were at 8.3 or something.
Yeah, it's about 6.3 now.
Wow, that's great.
That was the CPI number, correct, today. So last, yeah, there you go. Yeah, and again, so when you see that, if you rewind a month prior to that, you see this, it's spiked up, and that's what really spooked the market. In fact, that's what led us to the peak of our interest rates when the 10-year hit 4.3. And then today, fast forward today, we are at 3.8 now in the 10-year. And again, that's that from peak to trough. I mean, that's like 200 basis points in price, you know, which could take you from a 7.25 to a 6.75, you know, just as a random example. But that just gives you the idea of the impact of that kind of a move. And it also, you know, when you think even more future tense, if we get another month of declining CPI growth, and again, they compare it year over year. So if you rewind to 2021, you know, at the end of December or January of excuse me, where are we? Yeah, September, December of 2021. It's going to compare next month to those levels as well. So again, when you look at that correlation, if it does come down even further, that's going to be an even more green light for the markets to rally, because then at that point you have two meaningful data points for the Fed to say, you know, I think we're doing our job. We don't need to mash the accelerator quite as hard. And so that's what we're all watching right now.
One of the things that the consumer misses the forest for the trees is they say, well, I really want my 6% rate. Now it's 8%. So, or whatever the case. But Aaron, when he locks in rates and when I lock in rate, Aaron does a little bit better than I when it comes to the actual dollars and cents. Rates are important, but dollars and cents is still the most important thing. And the type of products, Ellie, that you're selling with those price points, you know, having a 0.5 point or even a full point increase in rate, the dollars and cents is not that much. Okay. Aaron, jump in anytime you want.
Yeah, it's on that point, you know, if you start, a lot of people, you know, they think rates and they, you know, automatically kind of associate it with maybe something closer to like a primary residence mortgage, which, you know, a lot of times are going to be, you know, by nature, you know, a higher dollar amount than that of an investment property. Not always, but a lot of the times. And, you know, of course, depending on what you're buying, but yeah, you could, you know, don't get discouraged by maybe a 7.5% rate. Even comparing it to 6.5, you might see less than $100 a month difference in the payment at the end of the day. And kind of on that note, and kind of going back to earlier, excuse me, when we talked about how this 0-point interest rate environment is gone and has been gone for, you know, several months now. Well, as the buyer, keep in mind that, you know, while you might be having to come to the table with 2, you know, sometimes 3 points, depending on what you're putting down, what type of property you're buying, the buyers are getting a lot more power, negotiating power, getting these points paid for by the sellers in a lot of cases. So use that as leverage. I encourage you to use that as leverage as the buyer, and rather than maybe negotiate, take a little bit off the top of the purchase price, instead have them buy those points for you, buy down that interest rate. You're saving that money out of pocket, and you're increasing the cash flow, at the end of the day, saving more in the pocket for your next property down the road. So, again, just do the math time and time again. It's worth it, because you'll quickly tell that the deals are still there. And especially now we're transitioning into a buyer's market where you've got lots more negotiating power, all the more reason to keep going.
I'm glad you brought that up, because we're seeing that. Well, we've been saying this for 6 months now. Okay, we're starting to see that narrowing of the margin. Now I'm having to pay a point. Now I'm having to pay 2 points. Well, the providers that Allie works with, they're saying, my margins are tighter, my cash flow is less. What do? We'll help the consumer out. The consumers, just like you and I, we like to get something for free, right? If you're negotiating, hey, can you give me a couple of points if I buy the house? And a lot of the providers are saying yes. Builders are saying that. Even on the consumer primary residence market, the sellers are starting to do that. So they're helping out the consumer, because it does help their bottom line out, but they got something. It helps them have peace of mind for the transaction. I know it sounds a little corny, but it's true.
Well, and I think too, people have probably heard me say, like, my St. Louis provider, he's on the Illinois side. He was the first one to kind of really start offering this. He offered it without me even asking about it. But one option, so if the rate right now is 7.5% and 4 points are paid, that can get it down to about a 6.5, give or take. I don't know if those are the exact accurate numbers right now, but the provider that I work with in St. Louis said, listen, legally, we're only allowed to pay up to 2 points, but if we pay 2 points towards the buyer's interest rate buy down, and the buyer pays 2 points, that knocks a whole 1% off of the interest rate, which is a big move. And like Graham said, a lot of providers are starting to be willing to do this because of the slowdown in the purchasing. So that's one option to get your rate down. But Graham and I talked, was a week or two ago, and Graham said something really interesting that kind of changed my thought, because I was running around. I was like, pay 4 points, it'll be, and 25% down. It'll be great. You can save your interest rate. But Graham made a really good point, is instead of spending your money on the points right now, save your money, stick with a higher interest rate, and use that money for the buy down later when the interest rates go back down. So let's say they go down to 5.5%. Well, when you go to refi, you can pay for your points then and knock it down even lower from 5.5. So I really like that approach. And if the sellers are willing to pay 2 points, let them pay 2 points, but that doesn't mean you have to pay your 2 points, kind of thing. So there's different ways to work this. And, if I really like what Aaron was saying about the dollars. So let's say that the difference in whatever the higher interest rate from the lower is $100 cash flow a month. Let's call it a year's worth. So that's $1,200. So you're not buying a property because $1,200 is money that you don't want to lose out on. But again, the profits that you make over the long term of these rental properties, $1,200 is laughable at that point. So that's kind of, tying all of these different pieces together. This really starts getting into the strategy conversation. Number one, understanding how rental properties really profit, because when you really understand that, you're not going to care about a 7.5% interest rate. Like Aaron was saying, it's the dollars that matter. And then tying it back to what Graham was saying about strategy. Okay, well, knowing all of this, what's my best option? Maybe I don't spend the money on the points right now. I do it later. How do I want to work this in support of knowing that this property is going to be profitable over the long haul? So you're really taking all these pieces together, and that's kind of the investor's ball cap that you're putting on to work this in your favor. And I think it's crazy for anyone to assume a 7.5% interest rate is a deal breaker.
I agree with and what you and I talked about. I'm still going to say, I agree with that. Save your money today, take it down the road and spend it tomorrow. But one of the things that, once again, the consumer says, I got to have that particular rate because it makes me sleep better at night. I can put it under my pillow. Okay. But the thing about it is, if you want to spend, say, let's say it's 2 to the party and the seller's going to pay 2, but you're going to want to pay 2 more and buy it down because it's going to make you feel better. Well, here's the problem that exists. On some of these smaller loan amounts, Fannie Mae has a thing called a high cost threshold, which means they allow up to no more than 5% closing cost. Okay. And if you have to take into account title, all those other items, closing costs for the lender, I mean, that stuff, that's considered an APR that starts to push that number up through that 5% ceiling. So sometimes we run into problems there. Now, we have looked at some ways through compliance. If the seller is actually given a true seller discount, we can, identify it as a bona fide discount, but that's a compliance issue. But I'm just saying, save your money, as you say, wait till next year, spend it then.
If anyone's worried about, because there is a slight level of speculation about this, because it's like, I'm certain the interest rates are going to go down next year. So I only have to deal with this higher interest rate for a year. What are the chances of that not happening? And, or kind of related, how did the 1980s get to a 16% interest rate? Like, are we at risk for, it's like, fine, I'll get the higher interest rate now. And then next year, the interest rate's 16%. They're like, hey, Allie and Graham said I should do this. Like, what can people expect if anyone's fearful on it from that angle?
Well, Aaron or Andrew, I'm gonna let you jump in because I know it's cyclical. So I'm gonna let you expand a little bit further on that.
Sure.
Andrew, what happened in the 80s?
Well, you think about affordability, that's one wrinkle in that, the cost of living, the average salary, the wages were a lot lower. And of course, the appreciation story, back then comparatively where housing was, there's one thing that you're not going to hear this from a ton of economists, I should say, or economic theorists or what have you, prognosticators, such as myself. Not really, but you one of the things that I learned recently, and so I won't take credit, but something I hadn't thought of is at higher rates that our debt is, we have to also finance at that same level. So when you think about how much more debt as a country we have today, and the amount it would cost to refinance that debt at a Fed fund rate of 4.6, 5 and a quarter, whatever it might be, it would break the system to hold on to that long term. I mean, we're in a election midterm cycle, we're going to be coming up to an election, there's so many variables that go into what the Fed can do from a tool basis, but also what would happen that could potentially break the system as well. And that actually includes the recession piece. Although no, we cannot say rates are definitely going to refi. You're definitely have a refi opportunity in the next, 6 months. But just from a mathematical equation standpoint, there's almost a point that we're going to be boxed into a corner where they're really, I've said this a few times on a few of these. Today, it's more psychology. I feel the Fed's mission. They have had to raise rates so high so fast because they know that once there's a crack or something that occurs where they will no longer have the ability to raise rates, they've been batting a no-hitter as it pertains to the economic data up until this point. They've had still a strong jobs numbers. They've had like I said, the pieces that are the inflationary costs that are creating this environment. They've had every reason to continue hiking without saying, okay, the economy is about to break. But the moment that fracture occurs, then the bottom is going to have to drop out because they want to be able to get as high as they can to have that dry powder. And so that's kind of where I would say is, yes, we can't have a crystal ball, but just as the whole system, when you factor in all the different variables, it's not really but an if, but a when type of situation.
I have a question for you guys, and it's definitely teetering getting out of your wheelhouse to some extent, but you guys see appraisals and all that kind of stuff. I think there's two reasons people are not buying right now. Number one, interest rates. We've been talking about that the whole time. Cash flow squeeze. Nobody wants the high interest rate. But the other thing that people are talking about is they're waiting to see if prices drop. So what, can you guys speak at all from your perspective and what you've seen as far as what could the expectation be? Because someone might be sitting there and be like, okay, great, I buy that argument of like, get the higher interest rate now, refi later. But why would I do that if I could just wait 6 months and see if housing prices really do drop? Because then I get it cheaper and I save myself a refi versus, and also too, if someone's going to refi and suddenly the appraisal is not going to come in as high, that could be hindering too. What are you guys seeing as far as that side of this, as far as the housing prices? My understanding is that so far it's only the bigger markets like LA, San Fran, New York, like those, the retail side is starting to see the price hits. I haven't seen any price decreases on the turnkeys or maybe, you know, smaller Midwestern stuff. But what are you guys seeing? And like, do you have any input in terms of, should people be sitting on the sidelines waiting for prices to drop, or is there reason to believe that they're not going to drop?
Well, as we talked about it earlier, I mean, it's a good time to buy. Okay. And if you're going to wait for those prices to come down, well, that really perfect asset, somebody's going to buy that. Okay.
Yeah.
So to answer your question, you can't measure the appreciation and depreciation from California and the East Coast. You just can't, okay? Because the markets that you sell in, like you say, in the Midwest and Southeast, are much different type of markets where they're not as volatile, okay? Take Alabama as an example. I mean, you might get 4% or 5% appreciation on a good day with the wind behind you back in the last 3 years, but the depreciations are not going to go there. Even where I live in Dallas and Fort Worth, you know, we've been experiencing double-digit increases in appreciation. I've never seen it in the 25 years I've been at it. So I took advantage of it, like I told you a minute ago with the exchange. But back in 08, we only saw a decline of a depreciation like 2%. So to answer your question, we haven't seen a missed appraisal yet. Have we, Aaron? I mean, he monitors that more than I do.
They're rare and far between lately. So
I mean,
I've heard people saying, they're like, well, I'm not going to buy right now because the providers haven't dropped the prices any, so I don't want to overpay. And I'm like, yeah, I'm not exactly sure that's how that's going. It's like the appraisal is the perceived market value, and those, in my experience, aren't changing. Like the values of these properties aren't going down, so you're paying exactly what you should be paying, has been what I've seen so far.
well, they've been doing this for the last, 3-4 years. Now they're starting to flatten out. Have they gone down yet? I haven't seen it. Okay.
Mm-mm.
And I have inventory all over the US, and I'm looking to cash out one now. And was it Florida? I think it is. And I know that my value at one time was probably 450,000. Even if it came in at 430, that can't be that big a deal. And I quite frankly don't think it's going to hit 430. I think it's going to come in higher, but that's just me. It just depends on the market. It really does. But the market says you're in, Allie, I haven't seen hardly any decreases.
Mm-mm. Yeah, that's why I was wondering if you guys see the appraisals. I haven't seen anything, and I haven't seen any suggestions that it's going to decrease either. Because again, you know, when you think about it, like the turnkey providers are selling off what inventory they have already purchased. So they obviously aren't going to get those houses any cheaper. But the question is, are they going to get the next round of houses cheaper? But kind of like what you're saying is, I haven't seen that market have decreases, like the wholesale market, for example. If a provider is getting their properties from a wholesaler, are the wholesale properties coming in cheaper now? And I haven't seen that happen.
God, I'm sorry, I slipped my mind. I had a really good question, but anyway, go ahead. I'm sorry.
Not good. That was it. No pressure.
I mean, we're welcome to take any questions if you like.
If anybody, if you want to put them in the chat, or you're welcome to just unmute yourself and jump on in. You've got the panel of experts right in front of you. And I mean, these three guys, I don't know where I am on your screen. I'm right between all three of you, but you've got three guys that you don't normally have as much access to. They're always happy to help out, but you've got a lot of brains behind everything right now. So ask anything.
Marcus, I'd love to hear from you.
I always call Marcus out. Last time he was on one of these calls, he was driving, and I was like, I was like, you better not have your hands on that phone.
There he is. I knew he'd show up.
I've got a real quick question. You guys, maybe I missed it, but what about arms? I mean, everyone freaks out over arms. I kind of like the 7.6 or the 10.6 arms if they're lower. And I understand lately, because of this inverted curve, they're not really much lower. But for a while there, you could get like a point lower if you're just willing to guarantee, I mean, for 10 years or 7 years, most people refi by then anyway. So why not just get an ARM and save a point? Did
Well,
you guys talk about that?
No, but that's a good topic. I'm glad you brought it up, and I'm going to share my opinion, then I'll let Andrew share his. Some of my competitors that may or may not work for like a bank or a credit union. Credit unions are really notorious for doing this. Notorious is not a good word, but they have the ability to offer ARM products at a much lower rate because they're shelving these products. Okay, but they have so much capital they can work with that eventually will dry up. So I've seen a lot of flash in the pans, Ben, in the last 7 or 8 months, talking with the guys in Tampa. You know what I'm talking about? He says, okay, we got this guy over here. And I called him the next day because I had a deal going. He goes, oh yeah, we pulled that off the shelf. We're not doing it anymore. So these are temporary. Okay. Fannie Mae products, the 5, 7, and 10-year products typically don't have as much margin like we were talking about earlier. So yeah, you could probably get maybe an eighth, maybe a quarter point reduction in rate, but you're having to spend more than 2 points to get there. They just don't put any margin in them. And with that, Andrew, I'd let you kind of step in and explain that whole scenario.
Sure. You're right. Ben, I saw where there was a bit of a gap. This was probably maybe June, July of this year. And then the curve continued to invert. And like Graham was saying, as far as the proprietary like bank balance sheet type ARMs, those came about and then they dried up or the liquidity got used up. But really the environment is much different than when ARMs used to exist in a normalized state, and the curve has everything to do with it. We operate in the secondary market, which when you think of an investor, they're wanting, everything that drives the security prices and everything that passes down to us, to the buyer, is driven by prepayment speed and the value that if someone's going to buy a loan and hold that loan on their books, what's the expectation they're going to make their money back and make profit on it. And of course, in an ARM environment, it's already a prepayment driven type product, meaning a short-term vehicle typically. But in an environment even still like this, when you think about how quickly rates can go the other direction, there's just no demand. And so I don't foresee the ARM market really materializing anytime soon. I think the curve has everything to do with that to start. And then again, when you have a 30-year fix that's just right on top of those, even the 7/6 products, it just doesn't make as much sense. And some things that we offer to kind of combat that is like the buy down options, where you can start with a year or two ahead at a lower rate and then eventually find a static fixed product after that without any fear of it being variable or move around, and just not have to worry about the refinance if it doesn't make sense to. So you've got a lot more flexibility with the fixed, and you can hold it out to wait for the right timing for the market to turn. In the event that maybe we dip but not quite hit a sweet, and you just want to wait to see what materializes, you have a lot more options that way. That's my personal take.
They just don't juice those products on the ARM products like they do the 30-year fix. There's just more profitability there. That's why there's more flexibility to get a little bit better than having to pay 3 or 4 points for an ARM. Okay, some of my competitors, and you probably know who they are, Ben. We had a conference call just last night. We were talking about the ARM products and talking about some of the credit unions, wherever they may be in the country, that are offering some of these products. But once again, that's a flash in the pan. It's short term. If you can grab it while it's available, hey, I'm always the first one to say, if there's a guy out there with a better bell or whistle than me, I'm going to be the first to admit it. But that's not going to last forever. We're here to stay.
Related note, what about the interest only loans? I've heard a lot of people talking about those. Like, is that a strategy you would recommend given the current environment and rental properties in general, or is that kind of a watch out for them?
Well, when the Dodd-Frank came out in 2010, they changed the playing field of the industry. Okay, they limited a lot of things like neg-am ARMs, 40-year terms, interest only. So it's really not available on the Fannie Mae products. You find those more into the more portfolio world or the DSCR world, or we call it the non-QM. All Fannie Mae products right now are considered qualified mortgages. And then there's a non-qualifying mortgage market, and it's out there. We have non-QM products as well. Typically, those rates are a little bit higher, but they do offer some interest only.
I was
I'm
gonna
not
say,
gonna
while we're kind of talking about them, do you want to give people, because you offer the non-QM, so if somebody doesn't have the income, and anyone new and not familiar with these terms, the Fannie Freddie that he's talking about, that's what people know as the conventional mortgages. And usually the rates on those are usually the best, I think.
They are.
But also the qualifications are a lot higher, and a lot of people, for a whole variety of reasons, don't qualify for them. So if you're in that boat where you can't get a Fannie Freddie, you can do what Graham's talking about, the non-QM, the non-qualifying. And do you want to just give kind of a Cliff Notes rundown of what it is, what the expectations are, like what do people need to have to qualify for one, but also too, like how are those rates currently comparing to the conventional Fannie Freddies?
Well, the non-QM market is always higher because it's a higher level risk. Okay. They don't, good example, Marcus. He's at more than 10 loans. Well, Fannie Mae caps you out at 10 loans. Okay. Now he's forced to go into that particular world. I'm in that same world. I have to go with DSCR lending for everything I do because I have 43 loans. Okay. But the difference between the DSCR, the non-QM versus QM looks at three things: your credit, how much money you make, how much money you have. And we make a lending decision on that. The non-QM world, they take a look at your credit, how much money you have, and that's it. They don't look at any tax returns. They focus and they underwrite the property, which means we hope the property itself can generate a good DSCR number, and they like to keep it between 100 and 125. A lot of lenders will go even down to 75, but that influences your rate. So the DSCR products have a purpose. They really do. I mean, they help me out. They are going to help Marcus out. But I've always said, use up the golden ticket first, which is Fannie Mae. Okay. If you can qualify for a Fannie Mae note, let's do it. Well, I'm buying 2 loans. I may not qualify for that. Well, if I can get you qualified for 1, I can get you qualified for 10. They all have leases. They all talk to each other, and they all offset the liability. So that's how we work in the Fannie Mae world. In the non-QM world, they don't really take that into account. They focus on that one property. That's it. Does that help?
Yeah.
That
What are the current rates that you're seeing right now with conventional and the non-QM side, just so people have a comparison? Like, are we talking half a point or half a percentage difference, full percentage, like ballpark? How much higher are they usually?
Well, I priced one today. Well, this is not a good day to measure, but let's say we're at 7.5 today. I locked one today, which was I got it down to 6.875 because of what Andrew just discussed a minute ago. There was 100 basis point variance today because of the CPI. Today's not a good day of measurement. So let's just say 7.5 is pretty much a good Fannie Mae rate today. On a non-QM, you're probably looking at 8.5 to maybe 9 or more. So it is a little bit higher. And that's even on the ARM products.
Yeah, and one thing for people to know, because we were talking earlier about if you get a conventional mortgage at 7.5% and the rate goes down to 5.5% next year, you can refi. You can also, a strategy, Ben brought up adjustable rate mortgages or the interest only loans, and then these non-QM loans. Just because you get a non-QM loan now, let's say it's at 8.5, if you don't qualify for a conventional right now, but you will in a year, let's say you just started a new job or you don't have the income requirements or whatever, but you're going to, you can do the non-QM now. And when you do that refinance, flop it over into a conventional. So you're not tied to one loan or the other. And I did that on one of my first turnkeys where it was taking a while to close on the property and I was quitting my corporate job. So I was losing my W-2 income. So I got an adjustable rate private loan. And I refied it before the rate changed, I think 3 years later, and into a conventional, and it worked out perfect. So again, it goes back into that strategy. And as an investor, what's going to make the most sense for what you're working with? How do you get all these loans working with each other in order to best maximize your returns?
Well, I had a guy just this morning, and he's in the non-QM. He started a new job, whatever the case. He couldn't qualify conventionally. So he recognized that. So we're doing a DSCR loan for him. But the DSCR loans, to getting the pricing, there's a lot of variables, even more so than what we deal with on the Fannie side. One of them is the prepayment penalty. A lot of the non-QM lenders will sell the prepayment penalty and explain to you how to get out of it later. But when we were talking on the phone this morning, I said, okay, here's your price with a 5-year prepay, and here's one with 0 prepay. He's going, well, if the rates are going to come down next year, why should I go with a prepay? So he took a higher rate. So there's all kinds of ways to skin a cat. And the only thing I can recommend is just give me a call. We can talk about whatever your scenario is.
Yeah, and I did put for anyone on the call, and I'll also wherever I'll put the video out in a lot of different places. I threw Graham's link and email address over in the chat, so you guys can get it over there, and then I'll attach it to wherever we blast this thing out.
Okay.
Cool. Anyone else have any questions? I'm trying to think if I have any last ones for you.
Got a quiet audience today.
Yeah, quiet. I will say, you said you made a statement. We've kind of answered this question, but you said a little while ago, it's a great time to buy. And I think people are not in that same mindset. So like if you were going to tell either a new investor or even an experienced investor right now, why you make that claim, why is now a good time to buy? Like, why should they be purchasing properties in this environment? What would your answer be?
Well, the availability of product for one, because we've been running scarce on that. Now we're starting to see some inventory rise. We're seeing the seller to obviously come up with seller concessions to make it work over and beyond. Okay, here's 2 points. Now we're going to give you management free for a year. I mean, there's all kinds of creative ways some of the providers out there are doing it. Personally, I would take advantage of all those things that the seller is willing to do these days, because I know, as we've said this before, we're marrying the property, we're dating the rate. Okay.
Yep. Oh, I always forget that one, and I love it. Well, and too, another reason is 2022 is the last year for bonus depreciation. So if anyone's going the cost segregation route or any of that, that's another advantage. And, when it goes down to 80% in 2023, that difference in income that you could get from that bonus depreciation, if you file it that way, well, makes up for a higher interest rate. And then you get to refi it later and increase your cash flow. Like, there's just no reason that properties don't have to be profitable right now at all. There's so many ways for them to really generate a lot of profits. And like you say, world's at your fingertips as a buyer. We just shifted from a seller's market to a buyer's market. It was, in my world, it felt like overnight, which is great for the buyers. Like you do have the pick of the litter. So you can make these negotiations with the providers. You can buy what and where you want to buy. Like, you can make it happen however it's going to best work for you.
I agree.
Cool. Anyone else got any last questions? Last call. Ben's back. Oh, he only turned his camera on to say no.
Come on, let's have it, Ben.
You got to come up with something now.
Okay, well, I don't know. I wanted to say goodbye, but one thing is, everyone's all freaked out about interest rates, blah, blah, blah. And then they're saying, well, why don't I wait until prices lower? But in the markets that, Allie, that you're focusing on, in the Southeast and Northwest, I mean, we're not talking about Corinthian mansions on a hill for millions of dollars. If anything corrects in price, they will. But the bread and butter, $120,000 to $220,000 houses, I don't think are probably going to correct all that much. Yeah. And in fact, with inflation at 8 or 10%, that $100,000, to make the math easy, that $100,000 property that you're passing on now because the interest rate's a point or two higher than you would have liked, if inflation kicks in or continues, then that same property is going to be $110,000 last year. So you just tripped over a quarter to pick up a penny, and it just kind of seems counterproductive. You should just buy it now, do what we've been talking about, refi when the rates drop, because if you sit on the sidelines, that same property might be 10% more in a year. So it just seems short-sighted.
It's like, yay, I finally get a lower rate, except now I'm paying 10 or 20K more for the property. And I'm like, hello.
Yeah,
like,
exactly.
People are wanting, and this is all over like what Aaron, the math he was doing. We're talking about like $100 a month in cash flow. So right. You saved, or you got yourself your $100 a month in cash flow, but you spent $20,000 to get it. And yep. So, yeah, I love the what was
plus the time wasted while you waited for prices to magically drop.
Yeah, all the while, again, you go back to the strategies like refi it later. You can do all sorts of different things with it. And yeah, I'm with you on that. And I just don't know that I don't think those markets that we're talking about, you're right, the mansions and the big markets and all that they're taking a hit. But I'm not seeing anything on, in small rental property investor world right now.
Right.
That was a good statement, Ben. Thanks. You're hired, by the way.
What was the one of tripping over a penny to say?
Tripping over a penny. I love that. I'm about to use that.
I'm like, wait, I didn't have my pen.
I sometimes get it. I sometimes get it wrong, but I'm thinking about it logically. I think it's trip over a quarter so that you can pick up a penny.
Oh, like, that might be it.
You've ignored the quarter. You tripped over it. Now you
That's a good
skinned your
one.
knee and you've got a penny.
Yeah, and I think I think maybe you just said it, or maybe Aaron said it. We were talking about inflation. So like, the profit centers, if anyone's not familiar with the profit centers, I've suggested a couple, or I've alluded to a couple times, the 5 profit centers: cash flow, appreciation, tax benefits, equity build via mortgage pay down, and hedging against inflation. So I always picture it like a bar graph, and each of those profit centers has a bar, and the cash flow bar has been pretty high for a long time. But now the bar is coming down. So we're not getting as much cash flow, but we're talking a lot about inflation. Inflation is hitting record levels. So it's like, as one comes down, it doesn't mean all the profit centers are still down. Inflation is well making up for the difference in cash flow. So again, it's that investor mindset of you're seeing the difference. And kind of like I was saying, I'm not as inclined to buy the, sketchy D neighborhood cash flow properties, because I need that appreciation bar doing something. So it's like, I want a nicer property with a higher appreciation potential, taking into account the massive inflation we're all going through. And then, the cash flow bar at that point is, it's all balancing out pretty easy. And people aren't seeing it. They're like, it's not the 1% rule. And I'm like, oh. Like, the 1% rule has a place. It's kind of, I think I was telling Graham the other day, like, if you can't beat it, beat them, join them. Like, you know what, if I have a property that meets the 1% rule, I'm going to advertise it as a 1% rule property. Despite,
and I'll buy it.
Don't like, Graham's like, why are you marketing it? Call me. So, the 1% rule, it does have a place, but what it, in my experience, what it causes is it causes people to only look at that cash flow bar. And it's a very short-sighted bar when that's all you're looking at, for
Correct.
sure. You have to look at the bigger picture. But in people's defense, like I said earlier, over the last 10 years, no one's been forced to look at those other bars because cash flow was king. And now, I'm actually having a lot easier time talking to newer investors because they're not jaded over the cash flow, what the cash flow was over the last 10 years. We're just not there anymore. But again, like a few of us have been saying in different ways, if you sit on the sidelines because you want that cash flow bar back, how much are you spending waiting for this thing to happen? Like, it's just, it doesn't really balance out when you step back and look at it.
Agreed.
Yep.
Cool. Thanks for jumping in, Ben. Those were really good questions and great input for sure.
Thank you. You're welcome.
All right, Parham guys, the Highlands guys, I should say. Do you guys have any last parting words before we call it quits?
It's been fun. Thank you.
Yeah, well, thank you all. I mean, getting all 3 of you on a call at once is phenomenal. I know you guys are all busy, and I really appreciate the time you took to get on here. We'll blast this out to everyone. Graham, I've got your information in there, so we'll get people reaching out to you. And yeah, and also too, don't forget, Graham, he's already said he has 43 properties. Graham is an investor. There are a lot of lenders out there who just lend. It's just their job, but Graham he's an investor. So you can pick his brain from the investor standpoint, not just the lender standpoint. I think that's a huge asset when you're an investor and you're working with a lender. It is not required, but it is so helpful when that lender can help you strategize, because, us on the consumer side, we don't know all the lending ins and outs. And so, Graham might be able to say, hey, if you do this way, and then you think about they can really help with strategy. And Graham and his team, I mean, they focus on investor loans. So that's big. So take advantage of that for sure.
Thank you, Ellie.
Yeah, you bet. Well, I'll let everyone go and I'll send out the recording. And thank you again, huge. And if anyone has questions, you go to sleep tonight and you're like, oh, I wish I'd asked Graham that, shoot him an email or shoot me an email. I can copy Graham on it. But yeah, reach out. Don't be shy at all.
Thank you.
All right,
Thanks
guys.
for having us.
Take care.
Adios.